Welcome back, my friends. As you may have noticed, we are seeing many experts making many assessments and predictions about the economy. Speculative investments are having a disastrous year. Cryptocurrency companies are going bankrupt. FTX declared bankruptcy just this past Friday. Risk assets have been losing value at least since January. The benchmark S&P 500 is down almost 20% this year. Many stocks, tech and real estate related stocks, are down anywhere from 30% to 97%. A wave of layoffs is sweeping the United States. The layoffs are more concentrated in technology companies, but retail and shipping are not immune. Many real estate YouTubers are saying all sorts of things about the housing market. House prices are definitely going down. As we all know, inflation continues to rage in many countries. And the Federal Reserve is aggressively raising interest rates. That is raising the cost of borrowing. And many big purchases rely on borrowing. So, business for house and car purchases is in decline. There seems to be some debate about what is really going on. And today, we are getting ocean-going freight rates are in freefall. Freight rates for cargoes from China to the US West Coast have fallen by jaw-dropping 90% over the past 12 months. Logistics managers are absolutely stunned by just how fast trade demand has fallen. Manufacturing orders for China from the United States are down 40%. One U.S. logistics manager has referred to the situation as an unrelenting demand collapse. Because of the sudden and dramatic slowdown, Chinese factories are shutting for an extra 2 weeks during the holiday season. Is this just a correction or is it a collapse? Or, is it a slow-motion train wreck in which prices keep slowly trending downward for a long time? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Ocean freight contract prices basically cratered in November. Fast rising interest rates and cooling demand. Federal Reserve Chairman Jerome Powell is trying to engineer a so-called soft landing for the U.S. economy. Many economists think that this can quickly turn into a recession. Logistics companies are now expecting an all-out price war in 2023. There are just too many ocean freight vessels and too much container capacity in circulation. Logistics managers are sending a clear message to their clients about freight rates. The ocean freight market is correcting itself at a far faster pace than anticipated. We initially expected the market was about to correct itself and normalize sometime in 2023, but it comes much earlier than we expected, shipping firm HLS recently wrote to clients. The peak in the market was the second quarter. From there it has been a steady decline, according to Alan Baer, CEO of OL USA. The market may have reached the low point in November, Baer said. But it is still too early to tell if this is a trend, Baer continued. But please do not feel sad for the major shipping lines. They reported nearly $122 billion in profits over the first 3 quarters of 2022. United States imports from Asia plummeted 11% between October 2021 and October of 2022. We don't find any grounds for optimism in November, HLS told clients. The ocean freight contract market tracked by Zeneta's Global XSI recorded a drop of 5.7% in November, the third month in a row rates have dropped, HLS continued. The largest month-over-month decline recorded since the launch of the XSI in 2019, according to Peter Sand, chief analyst at Zeneta. For many carriers, the fall in the XSI will trigger the fall in their average rates and will bring an end to record-breaking quarters, Sand said. We expect the challenging environment to continue given the 40% drop in Chinese manufacturing orders, Sand also noted. Logistics managers the current state of pricing to persist until next summer. In the first half of 2022, the supply chains struggled in trying to keep pace with unprecedented pandemic demand. What difference 6 months makes? And what a difference higher interest rates make. Suddenly weak demand and a weakened macroeconomic environment are forcing shippers to pivot quickly. As a result, the freight market now oversupplied with both ships and containers. This highlights the risk of a recession in the global economy. Central banks across the world are raising interest rates to fight inflation. Lower demand is one of the primary goals of these interest rate increases. The impact has been to push down supply chain prices. During the pandemic, shipping rates were at record levels. And that was a significant contributing factor to inflation. But supply-demand resetting can run the risk of creating a recession. Many CEOs are preparing their companies for a recession. And, if you follow this channel, you already know that the same CEOs are blaming the macroeconomic environment for anything bad. But the Federal Reserve is expected to continue with a higher interest rate policy. That is making many economists pretty nervous. The Federal Reserve thinks that it can engineer lower inflation without forcing a hard landing on the economy. Wall Street is not so sure. 85% of customers plan to decrease ocean freight spending in 2023, according to Peter Sand, chief analyst at Zeneta. 42% say their volumes will stay stable, consistent with 2022, Sand continued. That seems to suggest that freight shipping volumes between China and the United States will fall further. Despite the latest announced zero-COVID policy easing measures by the Chinese government, the delays in the delivery of raw materials and products by truck, Sand also said. Volumes are way down, said Joe Monahan, CEO of Worldwide Logistics Group. Overall vessel utilization is down even with the large number of cancelled sailings, said freight data firm Freightos. Despite the increase in cancelled sailings which has cut vessel capacity, the hemorrhaging of ocean freight prices continues, Freightos also said. Asia to the U.S. West Coast prices fell by 90% in the past 12 months. Asia to the U.S. East Coast prices decreased 19% in the past 12 months. Asia to Northern Europe prices dropped by 73% in the last year. Easing fuel prices are removing some pressure on container rates, according to a report from Judah Levine, head of research for Freightos. And the U.S. East Coast has still booked gains versus the pre-COVID market as more Asian trade has shifted there, Levine continued. Shipping rates between Asia and the U.S. West Coast are now at a level 5% lower than in 2019. Asia-U.S. East Coast rates are still 32% higher than 3 years ago. With the sustained pullback in orders, container volumes have fallen 9.3% year-over-year, Levine also said. The net result is an overcapacity situation. The decrease in demand will have a further impact on freight prices, said Christian Roelofs, co-founder and CEO of Container Exchange. In 2023, there is a high possibility of an all-out price war, Roelofs said. It doesn't seem that the capacity restrictions that we have seen in the past 2 years are due to return, Roelofs continued. So we'll just have ample capacity both on the vessel as well as on the container side, Roelofs also noted. With the competitive dynamics in the container shipping and liner industry, I don't expect especially the big players to hold back, Roelofs also said. We do expect prices to come down to almost variable costs. We also foresee market consolidation, Roelofs said. It is a very bad time for the shipping industry, said Asia-based shipping firm HLS. Carriers have been announcing more blank sailings and suspending services. They are trying to balance supply with demand by executing on an active capacity management strategy. Ports on the west coast of the United States appear to be taking the biggest hit. Back in June, J.P. Morgan CEO Jamie Dimon warned about a coming economic hurricane. But it may be less intense than Dimon originally feared, according to a new report from J.P. Morgan Chase. Investors somehow expected that positive inflation news would cause the Federal Reserve to rethink its course. But Federal Reserve leaders doubled down on their position that more interest rate hikes would be needed. And that the tightening will continue well into 2023 before pausing. Job growth has stayed fairly durable despite the fast rising interest rates. And consumers continue to spend money. But consumers are now focusing on needs versus discretionary items. We need to recalibrate the economy after several years of pandemic-related disruptions. Investors and CEOs have been preparing for a recession since the Fed started hiking rates. Some say the painful end of get rich quick thinking may be good for the economy. Speculators hoping to make a killing as cryptocurrencies got slammed this year. One of the most trusted exchanges for crypto trading, FTX, filed for bankruptcy. This year, there are new signs of a catastrophic decline in speculative investments in general. And this is part of a general trend that goes far beyond Bitcoin and other cryptocurrencies. A lot of so-called investments, like house prices and tech company valuations, look completely overvalued. That goes for so-called fintech innovations, including cryptocurrency, as well. These risk assets recently seem to be shooting for the moon. But they are now coming back down to earth. Many investors are getting burned as soaring speculative investments crater. Not just that, Many people are saying that this trend will actually benefit the economy. Recent years of speculative investments have encouraged get-rich-quick speculation. Rising interest rates mean a return to the old-fashioned kind of investments. Real-world investments that use money and workers more efficiently to create real economic value. Only when the tide goes out do you know who's been swimming naked, said Warren Buffett, a longtime advocate of slow growth. The US is teetering on the brink of recession. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.